Hey everyone, this is Trader Investor. In this video, I want to show you how I use options to enter long-term positions. Long-term meaning I'm holding for 3, 5 years or beyond for some stocks that I want to participate in for those long-term because I believe in the companies. And a lot of times for my long-term, I'm using fundamental analysis to do my entry, but once in a while I find that the charts tell me good entry points, so I will also include technical analysis to find good entry points, especially if I'm not in a hurry to buy those shares at that moment. If I have time, if it's something that I believe the company is going to go through some volatility, some up and down during the next few months, then I'm willing to be patient and wait for an entry. And what I want to do is use options to capture profits along the way as I wait for an entry price. I want to enter as low as possible and to find those entry points if price keeps going up until it comes back down to an area of value, which I will talk about in a minute here. Until it comes down to an area of value, I'm willing to wait and collect some premium. So that's how I use credit spreads. But I also use LEAPS, long-term equity anticipation securities. That's what the S is for, is securities. So there's no such thing as a LEAP. It's always LEAPS. So I use credit spreads or LEAPS for my positions, and I will explain to you how I structure both of those. So where I start, as I mentioned it a minute ago, is with save. Where is the structure? How is this market doing? Are we at an area of value? At an area of value is where I want to execute. So I look at save very, very regularly on all of my technical analysis. All my entries, whether it's in and out in 1 hour at the market open or in and out over a couple of days, over a couple of weeks, does not matter. I always look at save. What is the structure telling me? Is the structure broken or intact? Are we at an area of value, and can I execute based on that area of value? So based on that, then let's go to the charts and look at Boeing as an example. So I start with my monthly. This is where I start. So then I just draw support and resistance on my monthly. I just draw support and resistance. Nothing very fancy. It doesn't have to be extremely precise. I just want to know, because I am entering this for long-term hold, I just want to know where we are in terms of area of value and in terms of structure. This is all I care about. So where are we in terms of area of value? So once I have determined where we are based on the charts, from the monthly I go to the weekly and try to find if there's anything else that is telling a different story. But because usually on the weekly you'll see some deeper pullbacks, where the monthly just show you a single bar. That's what I want to focus on. And then what I want to do is, when price finds this area of values, can I execute? When price comes to those levels, can I execute? This is what I'm looking for. You'll see, as you can see, we have multiple opportunities over several weeks along the way. So how do we find those opportunities for our long-term hold? And how do we use options to capitalize? So once we are done with the weekly, then we go to the monthly. And for this setup, I use the daily as my trigger. I don't need to go for anything lower This is not about day trading or swing trading. This is long-term hold. Because of that, I just look at my daily charts. And so on a daily, when I approach area of value from the top, I approach an area of value, and then I break an area of value and I test it as support. This is areas that interest me to enter. Then I look for a break of structure from the pullback. I look for that temporary break of structure that shows me we have a pullback. We terminate that pullback when we start making higher lows and higher highs. So equal lows here. As soon as I break this highs, I'm okay to enter here as well. So this is how I view it. This is how I prepare the trading. And then for me to pull the trigger, I'll go to options and I'll show you how we do that. And to simplify for this video purpose, we will assume today is the day we're happy with the setup. This is the day we want to enter. That's the assumption we will make. And I will go to the options chain. And so the two things that I mentioned, I'll use credit spreads, bull puts, or I'll use LEAPS. I'll show you an example of each. For the credit spread, the first one, what I will do is I'll find at the money 30 days, about 30 days or more out, so that I can capture a lot of premium. That's the goal, is to capture a lot of premium. Shorter term, it doesn't give me enough premium. I just want to capture a lot of premium. But I don't want to just do a cash covered put. I want to be able to protect myself as well. So that's why I do credit spread. So first I will sell the at the money put. So when I sell the at the money put, I know the maximum gain for this position per contract is the premium that I collect. In this case, 1,195. That's the maximum I can get for this. But the maximum I can lose is a lot of money, because we are at 250. Hypothetically, if price goes to zero, I am out 25,000 minus the 1,000 that I collected. But when you're looking at that comparison for all practical purposes, 25,000 is my maximum risk on this. So in order to protect myself from this kind of risk, what I will do is I will go and buy 1 or 2 strikes out of the money put options. So I will add that to my risk. Now look at what happens. Now my maximum risk is also capped. The maximum I can lose on this trade is this the spread width, which is in this case is, as you can see from here, $10, so $1,000, but I am collecting the 400, so 600 is the maximum I can lose on this trade. Now I have minimized my risk. This is per contract, so depending on how many shares I want to buy, let's say I want to buy 500 shares, then I'm going to position 5 contracts. Now here's where the maximum loss could happen, and I would exit this position at that maximum loss. If price of Boeing at the time of expiration is way below my long strike price, meaning the 240, I might decide, this is just too much of a risk. I'm just willing to let go of the maximum $600 per contract and just give that up and close the position completely. But if price is not that far away from 240, or if it's somewhere between 240 and 250, I'll just take the positions, because my plan was a long-term hold anyway. So I'm gonna take those positions and wait those 3, 5, 10 years according to my plan. And going back to the price going way below 240, the reason why I let go of the 600, I might find another structure to set it up again and collect more credit along the way and be able to find additional income as I wait for price to recover. So it depends on the technical analysis, but without going into that, these are the two scenarios how I would enter or exit a position on the wrong side for me. Wrong side meaning price has gone away and not bullish, right? Price continues to be bearish. On the bullish side, if price continues to go up, I will capture my maximum profit and repeat this cycle over the next 30 days, the next 45 days, depending on how far out the options are. So just keep repeating this cycle. That's how I structure it. So that's one way. And in this instance, I'm spending 600 capital that is set aside as a margin when I'm collecting this 400 per contract. The other option that I have that I can do is I go to LEAPS and I go 2 years, about 2 years out, a year and a half to 2 years, depending on the months where we're sitting at right now. And what I will do is I will just buy a call option at the money. I want at least delta 50. That's my minimum requirement. So sometimes at a delta 50, you might be able to go way out of the money to make it cheaper, but I prefer to go in the money. And in this case, I just buy a call option. So here, the risk on this is I need to buy it, not sell it. The risk on this is the maximum that I paid. So in this case, it's 6,010. So that's the maximum I can lose on this trade. And the maximum gain is whatever price Boeing ends up being after expiration. And here, the purpose of structuring it this way is for every 100 shares of Boeing at today's price, it's about 25,000. But structuring it this way, upfront cost is about 6,000. So 6,000 versus 25,000. However, the 25,000 is sitting in the account waiting in case I get exercised. I am not risking that 25,000 doing something else because my plan is to buy those 100 shares. So every contract that I'm in with LEAPS, my 100 shares are also at play. That's how I'm looking at it. And so if price continues to go up in 2 years and price moves past the 250, I capture my gains and I can allow it to be exercised, and I have those shares at 250, and the expectation is in the next 2 years price will increase, price will appreciate in value. If that doesn't happen, then I'm out my 6,000. So on the reverse side, when you're looking at the risk, if I were to buy the shares today at 25, then at 250, then price has to go down by about $60, so at about $490 for me to lose, not 490, $190, excuse me. Price has to go down to 190 for me to lose this maximum loss if I were to just buy the shares right now. So because I'm looking at it that way, it's possible for it to go down 60 or go up 60. I'm okay to take the risks the way it is right now because this is for my long-term positioning. And if by expiration price doesn't reach there, then I'm all out my 600, the 6,000. So that's how I look at it. That's how I structure it. So whether you use LEAPS or you use credit spreads, this is how I structure it for long-term holds. And with that, I will go back to the chart just one more minute and say, when you're looking at the daily, you might find other area of values that you want to focus on for your entry as well, and then execute based on that.